Even if you're starting with $0, zero savings, zero investments, and zero financial background, this is not magic. It's not theory. And it's not one of those unrealistic motivational talks. This is a real life financial blueprint that works in any country, any economy, and any income level, as long as you follow the plan consistently. Before I break down each year from year 1 to year 8, I want you to imagine something. Imagine waking up 8 years from now, not worrying about rent, not worrying about bills, not worrying about job stress, no boss shouting at you, no financial pressure. Just imagine waking up and knowing your investments alone can take care of your life. That is exactly what this 8-year plan will do for you. Let's start with the truth. Most people don't retire because they don't have a strategy. They just live, spend, survive, and hope that one day they will have money. But money doesn't come by hope. Money comes from a plan, and the discipline to execute that plan. Now let's enter year 1. Year 1, the foundation year. In year 1, your number one mission is not to save money. Your number one mission is to increase your income and reduce your expenses. Why? Because you cannot invest if you're broke, and you cannot invest if all your money is swallowed by bills. So in your first year, you must focus on 4 important things. 1. Eliminate unnecessary spending. Remove anything that doesn't add value. Excessive data usage, impulse buying, eating out every day, expensive clothes, subscriptions you don't use, and emotional spending. 2. Create a small emergency buffer. You don't need a huge emergency fund. You only need enough to survive 1 to 2 months if something happens. 3. Build your skill set. Spend year 1 learning at least one income-producing skill. Content creation, graphic design, digital marketing, data analysis, copywriting, coding, video editing, social media management, trading a service, selling digital products. This will multiply your income later. 4. Create your first savings habit. Even if it's $1 a day, the habit is more important than the amount. By the end of year 1, your goal is simple. You should have improved your income by at least 30 to 50% and reduced wasteful spending. Year 2, the accumulation year. This is where things start to get interesting. In year 2, your goal is to save aggressively. Your goal is not to invest heavy yet, just save aggressively. Whatever your new monthly income is, save at least 25 to 40% of it. This is the year where you feel the pain. This is the year where you sacrifice comforts. This is the year where you do the hard work most people will never do. By the end of year 2, you should have a stable income, a stronger skill, a good savings habit, at least 3 to 6 months of savings. Now let's move to the year that transforms your life. Year 3, investing begins. This is where wealth actually starts. In year 3, you begin investing consistently. Your first goal is not to get rich. Your first goal is to build the habit of investing every single month without stopping. You can invest in index funds, mutual funds, S&P 500, ETFs, real estate REITs, high-yield savings, treasury bonds, dividend stocks, side businesses, real estate, if income allows. It doesn't matter whether it's $10, $50, $100, $200. The important thing is consistency. By the end of year 3, you should have an investment habit that cannot be broken. Year 4, momentum builds. Year 4 is when everything you've been doing starts to show clear results. Your investments now start generating small dividends, small profits, small compound growth, small interest returns. It may not be big, but it's a sign that your plan is working. Also in year 4, you should increase your income again. You should increase your investment amount. You should build multiple income streams. You should start earning from your skill. By the end of year 4, you're no longer living on one source of income. Maybe you have a job plus a skill plus a side hustle plus investments. This is how rich people are created. Year 5, expansion. Now we enter the year where many people quit, but not you. This year, your investments start compounding aggressively. You're no longer investing alone. Your money is now investing for you. In year 5, increase your investment percent. Invest in more stable assets. Build digital assets, ebooks, courses, templates, YouTube, etc. Grow your skill into a business. Start building wealth you don't have to work for daily. By the end of year 5, your net worth is much higher than when you started. Year 6, acceleration. Year 6 is the year that shocks you. Your investment returns start becoming serious. Bigger dividends, bigger compounding, a real portfolio, a predictable growth pattern. Your financial discipline is now automatic. You don't think twice about investing, it's part of your life. You now begin eliminating big financial stress. Debt is gone. Savings is strong. Income streams increased. Investments are growing. You're closer to retirement than you've ever been. Year 7, wealth stage. In year 7, everything becomes easier. Your money is now working harder than you. You now earn active income from your skills or job, semi-passive income from side hustles, passive income from investments, compound growth from your portfolio. This year, you reinvest almost everything your investments pay you. Why? Because you need one last big push before retirement. By the end of year 7, your portfolio is big enough to take care of most of your expenses. Year 8, freedom. And now we enter year 8, the year most people never reach. This is the year you stop depending on active work for money. Your investments alone now generate enough to pay your bills. Your year 8 responsibilities are simple. Maintain your portfolio. Continue moderate investing. Reduce lifestyle expenses. Protect your wealth. Lie below your investment returns. You can now work if you want, rest if you want, travel if you want, start a business if you want, spend time with family, do things you love, live life without financial pressure. In year 8, you don't retire because you're old. You retire because you planned it. Final advice. Remember, retiring early is not about luck. It's not about working harder than others. It's not about being born rich. It is about discipline, strategy, consistency, patience, financial habits, investing every month, avoiding lifestyle inflation, growing your income, reducing your expenses. If you follow this year-by-year blueprint without skipping years, you can retire in just 8 years starting with $0. Imagine waking up one morning and realizing that every dollar you've been quietly investing, without stress, without complicated strategies, without constantly watching the market, has grown into something massive. Not because you gambled on the next big stock, not because you predicted the perfect trend, but because you followed a simple, boring, proven strategy built on just 3 ETFs. Imagine looking at your investment account years from now and seeing that what started as $10 a day has turned into hundreds of thousands, maybe even close to 1 million, all because you understood one powerful truth. Long-term investing doesn't need to be flashy. It needs to be consistent. It needs to be smart. And it needs to be simple. Today, we're diving into the idea of the best 3 ETF portfolio for long-term investing, something that almost anyone can follow. Whether you're a beginner trying to understand the stock market, someone who's tired of jumping between hyped investments, or even a seasoned investor who finally wants a streamlined portfolio that works while you sleep, eat, and live your life. ETFs, exchange-traded funds, are some of the most powerful investment tools ever created because they allow you to own hundreds or even thousands of companies with a single purchase. They give you instant diversification, low fees, and exposure to markets that historically build wealth over time. And when you put the right 3 together, the results can be absolutely life-changing. Before we get into the 3 ETFs, you need to understand why this kind of portfolio works. Most people lose money in the stock market not because they choose bad companies, but because they constantly switch strategies. They chase quick gains. They panic during downturns. They react emotionally instead of logically. But successful long-term investing isn't emotional, it's mathematical. It's predictable over decades. And the biggest wealth builders are time, compounding, low fees, and broad diversification. With ETFs, you don't have to guess which company will win. You don't have to attempt to predict the next Amazon or the next Tesla. Instead, you let the entire market work for you. You buy the haystack, not the needle. Now let's talk about why a 3 ETF portfolio is one of the smartest investing approaches ever. Many people think investing requires having 10, 20, or even 50 different funds. But that isn't true. In fact, too many positions make your portfolio messy and your strategy unclear. A 3 ETF setup is powerful because it covers everything you need: domestic stocks, international stocks, and bonds. Or if you want more growth, you can tweak the ratios to match your goals. With just 3 funds, you can own nearly the entire global economy. That means you benefit from innovation, population growth, economic expansion, and global productivity, all without placing huge bets on any single country or company. So imagine again, you invest $10 a day. That's the price of a cheap lunch, or 2 cups of coffee, or less than what many people spend randomly without realizing it. $10 a day becomes $300 a month. $300 a month becomes $3,600 a year. And when invested into the right ETF portfolio with average market returns, that can grow to around $800,000 over several decades. The key is consistency, patience, and letting compounding interest do its job. Compounding is like planting a tiny seed that grows into a massive tree, but only if you leave it alone long enough. Now, as we talk through this portfolio, remember something: this isn't financial advice. You are in charge of your own decisions. I'm here to teach you the principles, the logic, the reasoning behind a 3 ETF approach so you can decide what's right for you. What we're doing is building a simple, long-term, highly diversified investment strategy that anyone can understand. So let's begin by exploring the first ETF. Because if you get this one right, you've already done the majority of the work. The first ETF typically focuses on the total US stock market. This gives you exposure to thousands of American companies across the large cap, mid cap, and small cap sectors. In the US market, historically, large companies like Apple, Microsoft, Google, and others have driven enormous long-term growth. But small and mid-cap companies provide additional upward momentum over time. A total US market ETF captures all of this at once. Instead of trying to find the next successful stock, you let innovation across the entire country work for you. Every breakthrough technology, every rising startup, every expanding industry in the US economy becomes part of your overall return. This ETF forms the backbone of your portfolio. It's the engine. It's the growth driver. Over long time horizons, 20, 30, 40 years, the US stock market has historically produced average returns between 7 to 10% annually after inflation. That's why people building wealth almost always have exposure to US equities. With this single ETF, you're effectively owning corporate America. You're owning companies that build the products you use every day, from your smartphone to your groceries to the software running your life. And you're earning a share of all their profits. But relying only on the US market ignores something important. The world is bigger than one country. And sometimes, other nations grow faster. That's where the second ETF comes in, a total international stock market ETF. This gives you exposure to developed markets like Europe, Japan, Australia, and Canada, along with emerging markets such as India, Brazil, and parts of Southeast Asia. When you invest internationally, you're capturing the growth of billions of people. You're tapping into rising middle classes, increasing technology adoption, stronger global trade, and countries that may experience rapid economic expansion in the coming decades. Some investors skip international stocks entirely, believing the US will always outperform. But that's not guaranteed. There have been entire decades where international markets outperformed the US. And diversification is about protecting your long-term outlook. When one region underperforms, another may thrive. By owning the global market, you're not betting on one country's success. You're investing in humanity's collective progress. Now you might be thinking, if we have US stocks and international stocks, why do we need a third ETF? The third ETF isn't for growth. It's for stability. It's the safety net, the cushion, the psychological anchor that keeps you invested during volatile times. This ETF is typically a total bond market fund. Bonds don't grow as quickly as stocks, but they provide two critical benefits: lower volatility and steady income. When the stock market drops 20, 30, or even 40%, as it has many times in history, your bond ETF helps smooth the ride. This is especially important as you get closer to retirement or as your risk tolerance decreases. Some younger investors choose to reduce bonds or skip them entirely for more growth. And that's okay. Your portfolio should match your comfort level. But a bond ETF provides balance. It reduces emotional decision making. It gives you liquidity during downturns so you don't feel pressure to sell stocks at the worst possible time. And even when rates change, bonds remain one of the most reliable tools for long-term risk management. So as you walk away from this video, idea with you, your future wealth is not created by one big decision, but by thousands of small ones made consistently. Every $10 matters. Every automatic deposit matters. Every month you stay invested matters. Your financial success is not somewhere far away. It's built bit by bit every day you show up for yourself. Overwhelmed or unsure about investing doesn't take complexity to succeed. It takes commitment. So imagine one last time. Imagine the pride you'll feel when you one day look back and realize that the most powerful financial decision you ever made wasn't a risky gamble. It was choosing a simple, steady plan and sticking with it long enough to watch it transform your life. Stop wasting your time on dividend stocks that pay you crumbs. If your money isn't hitting your account every single week, you're playing the game wrong. Today, I'm breaking down the exact 12 dividend stocks that can turn your portfolio into a real weekly cash flow machine. No hype, no fantasy, just a strategy that actually works for people who want consistent money, not random surprises. Let's get something clear. Weekly dividend income is 100% possible, but only if you structure your investments the right way. And most people have no idea how the schedule works. They buy random stocks, wait months for tiny payouts, then complain that dividends are slow. That's because they're doing it wrong. If you want weekly payments, you need three things: monthly payers, strong quarterly giants with different payment dates, high-yield boosters that fill in the gaps. Once you put them together, that's when the magic happens. Suddenly, you're getting paid 4, 5, even 6 times a month. Let's start with the core players, the ones that never miss. Realty Income, ticker symbol O. This company is the backbone of weekly income. It pays monthly, it's consistent, and it's backed by thousands of properties rented by companies you use every day: Walmart, Walgreens, 7-Eleven, and FedEx. This is not a hype stock, this is a machine. It pays you every month like a salary. Then we go to Stag Industrial, another monthly payer. They own warehouses across the kind Amazon and logistics companies depend on. Stag gets paid, and when Stag gets paid, you get paid. Next is EPR Properties, monthly. And this one brings entertainment money, theaters, attractions, ski resorts. People always go out. Businesses pay rent. You collect dividends, monthly. Simple. And now the boosters, the ones that give your income that extra kick. AGNC Investment, high yield, monthly payments. It drops bigger dividends, which helps fill extra weeks. This one is more volatile, but that's why it pays more, so it boosts your weekly numbers. Prospect Capital, PCC, also monthly, also high yield. When you stack PSCC with AGNC, suddenly your month is already crowded with payments. But we're not stopping there. To lock down all 4 weeks, you need strong quarterly payers with different payment schedules so they don't overlap. This is where the big dogs come in. Coca-Cola, KO, pays quarterly, but their pay date usually hits early in the month. That locks one weekly slot. Johnson & Johnson, J&J, usually pays in the middle of the quarter. That fills another week on your calendar. McDonald's, MCD, their dividend tends to land later in the quarter, which gives you one more payout week. Pepsi, Pep, another giant with payment dates that don't clash with Coca-Cola or McDonald's. This adds another layer of cash flow. Then we add a special one. Main Street Capital, Maine. This one is a dream for income investors. It pays monthly and throws in special bonus. Dividends twice a year. Those bonus drops fill random weeks you normally wouldn't get paid. That means more activity in your weekly income flow. And for stability, we add VYM or SCHD, top dividend ETFs. They pay quarterly but balance your portfolio, so even if one company reduces dividends, your weekly system stays solid. Finally, the 12th. Pembina Pipeline, PBA. A dependable Canadian energy company paying monthly. This one fills any remaining empty weeks in your monthly cycle. Now pay attention. Here's where everything comes together. When these 12 companies are combined, here's the effect. Realty Income pays 1 week. Stag pays another. PBA hits a different week. AGNC and PCC drop on different dates. Quarterly giants fill the gaps. By the time you line them all up, your portfolio goes from occasional income to consistent monthly income to near weekly income, and eventually into a fully optimized weekly cash flow setup. This is how real investors do it. Not by guessing. Not by hoping a stock pumps. Not by chasing TikTok hype. But by stacking real companies that pay on real schedules. When this structure is in place, your portfolio stops being a savings account and becomes a cash flow engine. And the crazy part? You don't even need a huge amount to start. You begin with small amounts, reinvest your dividends, and watch the income automatically grow. Your weekly payments get bigger. Your monthly income gets stronger. And over time, your cash flow becomes something you can depend on. This is not luck. This is not hype. This is not imagination. This is how people build real income through real companies. If you want your money to pay you every week, this is the strategy. These are the stocks. And this is how you take control of your cash flow, one dividend at a time. And here's the truth a lot of people don't want to face. Most investors don't have an income problem. They have a structure problem. They buy random stocks, wait forever, and wonder why their money isn't growing. But when you build your portfolio with intention, when you choose companies that actually pay, when you spread your payment dates across the entire month, that's when you unlock real financial momentum. Weekly dividend income isn't a dream, it's discipline. It's strategy. It's understanding how money flows. Because once you set this system up, something shifts. You stop stressing about the market. You stop caring about daily price swings. You stop chasing hype. Why? Because your money is showing up every week. Steady, predictable, consistent. And that's the goal. Cash flow that doesn't depend on your mood, your job, or the economy. Cash flow that works in the background. Cash flow that builds itself. This is what the smartest investors do. They create income that never sleeps. So if you're serious about getting paid every week, start with these 12 companies. Build slowly. Reinforce your portfolio. Reinvest your dividends. And watch your income transform from something you hope for into something you control. Because at the end of the day, true wealth isn't about how much you make. It's about how often your money pays you. Let me tell you something that completely changed the way I look at money. A few years back, I used to think that doubling a huge amount of money, like $1 million, was something only billionaires or finance geniuses could do. I believed you needed connections, insider information, or some risky investment that could either make you rich or wipe you out overnight. But that mindset shifted the moment I started studying how long-term investors actually grow their wealth. Not through noise, not through hype, but through simple index funds, especially the ones from Fidelity. So let me take you back to the moment this hit me. I remember sitting at my desk with my Fidelity dashboard open, just staring at the number. I didn't have $1 million yet, not even close, but I had this dream. If I actually double, I typed the question into Google. I read articles, but the information wasn't personal. It felt like math someone else did. I wanted to understand it for myself. That's when I started running my own calculations. I clicked into FXAIX, Fidelity's S&P 500 index fund, the same one almost every long-term investor recommends. I pulled up the historical returns. Some years were crazy high, some years were scary low, but the long-term average kept hovering around 9 to 10%. And I remember thinking, hold on, that's not even a risky investment. That's just the entire market. So I grabbed a notebook and wrote at the top, if I had $1 million, how long until it becomes $2 million? Then I came across something that felt like a cheat code, the rule of 72. You take 72, divided by the annual return, and you get the number of years it takes for money to double. I did 72 divided by 10 and got 7.2. I stared at the number again. 7 years? That didn't feel real. It felt too simple. I double-checked it using every calculator I could find. Same answer, about 7 years. And I'll never forget that feeling, because for the first time, I saw how people actually get rich. Not through gambling, not through luck, but through compounding. Then I tried something else. I said, okay, what if I didn't use FXAIX? What if I used FSKX, the total US stock market fund? I checked the historical returns. They were basically the same. Then I looked at the Fidelity Zero funds, FCRX and FSILX. Zero fees. That means more of your money stays invested, compounding on itself every single year. And the idea clicked even more. The less you pay in fees, the faster you grow. I remember running a simulation. I typed in $1 million as the starting amount, set the return to 10%, and clicked calculate. The graph jumped year by year. Year 1, $1.1 million. Year 3, $1.33 million. Year 5, $1.61 million. Year 7, $1.94 million. Year 8, $2.14 million. By year 8, the money had not just doubled, it passed the $2 million mark. And the funniest part? I wasn't even invested with $1 million at the time. I was learning all this with way smaller numbers, sometimes $50, sometimes $200, sometimes $500 at a time. But the principle felt the same. For the first time, I understood that the amount didn't matter, the behavior did. Then reality hit even harder when I looked at my own investing behavior. There were months I panicked, months I was impatient, months I was tempted to sell. But every time I looked at the long-term returns of FXAIX, FSKX, and the zero funds, I kept seeing the same pattern. The market always recovered. It always kept climbing. And the people who stayed invested during the worst dips were the ones whose money doubled the fastest. There was one specific moment I remember clearly. The market had dropped, and my portfolio was looking ugly. I was frustrated. I opened my Fidelity account thinking, what am I even doing? This is going nowhere. Then I clicked on the 10-year chart for FXAIX, and it zoomed out. All the small dips disappeared. All I saw was this steady climb, like a mountain rising over time. That's when it clicked even deeper. The short-term dips look scary up close, but from far away, they barely matter. That was the moment I decided. If I ever hit $1 million invested, I'm giving it the full 7 years. Not touching it. No panic selling. No shortcuts. And something interesting happened over the next few years. My smaller amounts started compounding. A few thousand became 10,000. 10,000 grew into more. And I realized firsthand that compounding looks slow at first, and then suddenly it accelerates like crazy. You don't notice the first few steps, but you absolutely notice the later ones. That's when I fully understood why wealthy people get richer faster. When you compound $1 million at 10%, you make $100,000 in the first year. But when it becomes $2 million, now you make $200,000 a year. You start earning more from compounding than most people earn from their jobs. And the wild part? You don't do anything. The money grows itself. So now, when people ask me, how fast can $1 million double with Fidelity Index funds? I no longer answer with theory. I answer from experience. Based on everything I've seen, everything I've calculated, and everything I've personally felt through the ups and downs, the truth is simple. It takes roughly 6 to 10 years. 7 or 8 is the sweet spot. And the only requirement is patience. No stock picking. No complicated strategy. No guessing the next big thing. Just simple, boring, consistent investing inside some of the lowest fee, highest trust index funds in the world. And whether you're starting with $1 million or starting with zero and building your way up like I did, the process is the same. If you trust the journey and stay invested long enough, your money will grow. Not overnight, but definitely over time. That's the real secret behind doubling your wealth with Fidelity Index funds.